All right, let's kick things off. Thanks everyone for joining. Looking forward today to talking all about the credit card space and how companies thinking about launching a credit card or already operating one can really build a product that's built to win against all of the other options out there. I'm excited to be joined by a really awesome panel of credit experts. First, I'll introduce myself. I'm Nick Newford, Director of Marketing at Synctera. For those of you that don't know Synctera, we provide the tech layer and program orchestration that allows banks and brands to partner together to launch fintech and embedded finance products. Last year, we launched our credit card product. So we enable fintechs, brands, and community banks to offer credit cards to their customer base. So it's been really fun diving into the space and kind of seeing, some of the new entrants to the credit card scene who have been making a lot of noise. Think about Robinhood, Built. And we've been talking to a lot of really interesting companies that are building unique use cases for credit cards that can help amplify their brand and business. Um, One thing I've seen throughout the process of us launching this product is just how much there is when you move from a debit card to a credit card that you have to now start thinking about. Once you kind of get into the true revolving credit space, this opens up things like uh, underwriting, APR, servicing, collections, a lot of new things for companies to think about. And our panel today is really going to dig into some of these topics as well as talk about the credit card space as a whole. So before diving into the conversation, wanted to first introduce our amazing panel of experts. So first we have Alex. I'll let you introduce yourself.
Sure. Thanks for having me. Alex Johnson. I write a newsletter called Fintech Takes. I've worked in and around the fintech space for the last 20 years, most relevant for this conversation, including a stop as the director of credit card research at a payments advisory firm. So, looking forward to today's discussion.
Thanks, Alex. Matthew?
Yeah, it's a pleasure to be here. I'm Matthew Goldman. I'm the founder of Totavi and the publisher of the newsletter Cards FTW. We help brands to build fintech-based credit card products with underwriting, platform selection, and implementation work. And I just am clearly obsessed with credit cards, so excited to be here.
Perfect. Scott, over to you.
Yes, thanks. Thank you, Nick, for having me here. Excited to be here with my other panelists. I loved the intro music, Hard for the Money, for those of you who started at the beginning. Maybe today we can make this easy for the money as we talk about getting into the credit card space and some of the intricacies there. But yes, thanks for having me again. I'm Scott Johnson. I'm president of the card division here at LoanPro. LoanPro is a phenomenal partner. Works a lot with the partners here, and we are a credit card ledger and loan management system. And excited today to talk about cards because anything that touches cards falls within my realm as president of our card division here.
Awesome. Thanks, everyone. So today we're planning on kind of diving into three areas of conversation. First, kind of looking a macro view of credit, especially for those of you who aren't in the credit industry today, kind of thinking about where's it been, where's it headed, what should people be thinking about. Second, really diving into the product strategy around developing a credit card product. And then third, once you have your strategy nailed down, what are the infrastructure decisions that you need to be thinking about once you're actually in the process of building out that product? One other note at the end, we'll be doing a Q&A. So feel free to drop your questions in the Q&A chat. We'll get to as many as we can depending on time. So with all of that out of the way, excited to dive in. First thing I wanted to highlight is this is a chart that I love seeing and kind of have integrated into a lot of our marketing materials here, which is that. So looking at the share of payment instruments that consumers use in the US. This is a chart from the Federal Reserve Financial Services. And if you look from 2016 to today, just how much the share of credit cards has grown. As you can see, in 2016, credit cards were well behind both cash and debit. And then over the years, they've just started to eat away at that deficit. And now they're actually pretty far ahead in terms of the most used payment instrument by consumers, well beating out cash and now narrowly beating out debit as well. So it's kind of really interesting to see this progression throughout time. And I'm curious, Alex, like based on what you're seeing, what do you attribute to this growth? And do you think this will continue or will it at some point stagnate? Kind of what are you seeing about this?
Yeah, I love this chart. I mean, I think what it tells us is that, to use a fintech cliche, like credit cards have great product market fit. And what I mean by that is a combination of the fact that they are incredibly useful to consumers, right? And that includes their function in terms of being able to provide additional liquidity. They obviously work extraordinarily well as a payment mechanism. I think the rise of e-commerce and mobile payments has been a huge boon to credit cards in particular because of their more robust consumer protections. Their rewards, obviously, are a huge thing, which I know we're going to talk about. And they also have really strong product market fit for institutions. Credit cards are one of the most kind of durably profitable products that any financial services company can offer. And as you said, Nick, a lot of companies that haven't had credit cards historically have gotten into credit cards for that exact reason. So when they're incredibly compelling to institutions that offer them and incredibly compelling to their customers, I think that's what drives this change over time. I will also note that credit cards, I think, have been very durable as a form factor. And what I mean by that is, you still see a lot of conversation online about like the design of cards. Matthew could do 5 hours just on the design of cards if we wanted him to go that direction. But like that's still a really important component to the marketing and use of these products. I think they've adapted well to changes in the broader ecosystem. They fit into obviously mobile wallets. We're starting to build more flexible credentials that give credit cards even more capabilities. So I think they've evolved well as the payment and fintech landscape has evolved, but they have that durable value proposition that's just really strong.
And Nick, the one thing I really like about this slide, I love, look at who the victim is here. It's cash, right? Look at the decrease in cash from 2016 to 2024. It's almost like credit has picked up almost every one of those share of wallets or transactions. And I think that goes to what Alex is saying is you look at this product market fit. And I love that description of credit cards. I know we're going to talk a lot about that today, but I really think that what's fascinating about this is the growth in credit and the shrinking of cash. And that's where I really think we'll continue to see that number continue to shrink from 14% to who knows where that'll end up. But it's very, very interesting to see how most of that, I think, has moved to credit and a little bit to debit, but almost all of it's moved over to credit.
Yeah, and I know historically, credit's been dominated by just a few players, but now we're seeing more and more companies offer credit products. So, Matthew, I'm curious to get your take on like with the share of credit cards increasing as a whole, how do you think these new players fit into the ecosystem? Are they going to continue to take market share away, or kind of like how does that work?
Yeah, I mean it's a funny story right now because one of the biggest entrants, the Apple Card, Goldman Sachs, core card structure is moving to Chase. And so there's a little bit of the rich getting richer right now, Capital One acquiring Discover. You're actually seeing the kind of top three credit card issuers gaining even more share, where the kind of 4 through 10 and beyond folks are having a decline in their share. But I think that's just because we're in the early innings here of this transformation. Fintech, took on debit first because debit is an order of magnitude easier than credit. There's a lot of reasons why credit is a great product, as Alex touched on, but we're just at the beginning of new entrants figuring out how to do credit products. And I think that it's inevitable in the kind of way that if you look back 10 years ago, maybe people are like, well, who are these Chime guys? And look at them now, right? Like one of the largest originators of new debit accounts. And so I think you're going to see a similar transformation on the credit side over time.
Yeah, and Matthew, so when we talked previously, I mean, obviously credit card usage continues to grow, but another thing kind of going on in the macro environment right now is you use the term uncertainty, which I really thought was a very apt term. So I'm curious if you can kind of unpack like what areas do you see the most uncertainty in the credit space right now, and how should companies that are either in it or thinking about being in it approach that uncertainty?
Yeah, there's there's some things that are persistent in uncertainty in credit cards and some things that are, I think, of the current moment. One of the funny things about credit cards is that they're very tied to the economic cycle, or one of the challenging things, right? Like people with high scores who are prime up until all of a sudden they're not, kind of is the way we look at it from an underwriting perspective, right? Like if you lose your job, if there's a big recession, things like that, you see a really big change, when that happens. And so that is uh that is something that can always kind of occur at any stage of the economic cycle. So that's always some uncertainty there. I think we're seeing some really interesting challenges today in terms of the potential regulatory environment. We have the Credit Card Competition Act, which could limit interchange. We have the pending merchant settlement with MasterCard and Visa, which could also limit interchange, right? And so there's some real potential pressures on that side. And then on the fintech front, there's this particular challenge, which is related to the private credit world, which is a hot topic, right? As most fintech cards are actually funded by these private lenders, warehouse lenders, capital lenders that are bringing in pension funds and insurance funds and other limited partners. And there's a bit of a blow up going on, not related to fintech credit cards, but as it squeezes the environment, that could lead to real funding challenges for the dollars actually being lent in a credit card P&L.
And one of the other ones, Nick, that I would add in as well, and Matt and I had the privilege of being on a panel a few months ago. I even hate to bring this one up, but we know it was not too long ago that the president was tweeting out about 10% interest rate caps on credit cards. And so I think you've got a lot of just uncertainty, and that's a great word, I think, for it, to talk about what can potentially happen in the marketplace. It is challenging when people are looking at, again, a couple of months ago, were credit cards going to be capped at a 10% interest? My gosh, we could spend an hour on why that would be such a horrible idea and why that would drastically decrease people's access to credit. But I think to piggyback on what Matt's saying there, I think it's so important to look at this to say, yes, there is uncertainty. So that causes some challenges, especially for new entrants. And I think existing players in the ecosystem to say, oh my gosh, what would that ultimately do? I mean, you could imagine what happened to credit lines if that was actually enacted. So unfortunately, I think that momentum is starting to die down. But I do think that we are seeing, still a lot of uncertainty in the marketplace right now.
And Alex, any thoughts from you on how, companies in the space or thinking about being in the space should approach this uncertainty?
Yeah, I mean, I think the most important thing is to have a plan, right? The worst thing I think when there's a lot of uncertainty in the market is to have a new product that you launch because, hey, that's the next product on our roadmap, and we've decided to do credit cards, or it's because our competitors are doing credit cards, we're going to do a credit card. That's a recipe when you're walking into a very uncertain environment for pain and loss and a misallocation of resources. By contrast, I think credit cards, as Scott and Matt have already said, like they can be an enormously valuable product. It is very early still in terms of the competitive market kind of reshaping itself. And while the big three issuers have a hold on a part of the market, as we're going to talk about, there are lots of other segments that you can serve and serve very well. But you have to have a very clear strategic intent for why you're launching a credit card, what your credit card is going to do differently. And I think if you have that plan and you have that clarity, it doesn't really matter as much what the sort of macro conditions are because credit cards, regardless of the macro condition, and this is backed up by the chart you showed, credit cards work in every environment, right? Credit cards work well in a recession. Credit cards work well when the credit market is doing extremely well. Credit cards work all the time, and they're a very enduring product, but you have to have a plan for how you're going to win and compete in a durable way in what is probably the most competitive product market in consumer financial services.
Yeah, so starting to dive into that, kind of thinking about how you can win. Matthew, I'm curious. So, when companies just start out and they're kind of thinking, okay, here's how I can envelop a credit card product into my existing business, what's kind of some of the first questions they should be asking themselves, or how can they frame that decision around not only should I be in a credit card space, but how do I actually do that as it relates to my business?
Yeah, I think especially for companies that are kind of expanding into credit cards horizontally, right? They already have an investing account or a debit account or some kind of other product and they're looking at adding a card, they need to look at two big things, as Alex mentioned. One is like, why am I doing this? What is the motivation? Is it extensive, user acquisition? Because one thing that's great about credit cards is people are more willing to try them than many other products. People do not change their checking account very frequently, but they will try new credit cards. People don't use multiple primary checking accounts, but they do use multiple credit cards on a routine basis. The second is, who is your user demographic and what is their credit profile? Because it is much harder to underwrite folks who have lower quality credit scores and do that in a way that's not creating too many losses, but it's also much harder to compete in the prime, super prime space where people have a lot of options. So understanding kind of what market you're going into there is really critical. And then thinking about how it all ties back to the rest of your product suite and being really thoughtful about what is the experience you want to have and what really matters. And therefore also like, how do you build it, right? Like, what are the things you need? Do you need really complex rewards, or are you going simple cash back? Do you need to build partnerships to do, special offers with merchants and all these things? And that all goes into it, because a credit card is, as Alex said, is like, a great product, very competitive, but also very, very complex. And there's a lot more to it than, hey, I'm just going to stick this card in people's wallets and they're going to spend money on it.
Yeah. And I find, along those lines that Matt was saying, a lot of people sometimes make this mistake if they're trying to be all things to all people in the credit card space. I think to Matt's point, being very specific, because there's a lot of programs out there that listen, you're not going to start offering someone, a reserve platinum card with a $10,000 or $15,000 credit limit. There's some very, very specific ways that, people that are looking at this and kind of thinking about how to get into the business, they don't have to start in the deep end of the pool. They can kind of start thinking about ways to start offering different types and flavors of credit products, whether that might be a secured product or a hybrid secured, or, having a partially unsecured balance. And so I think that that's a lot of what we're seeing as well right now, as people are starting to get into this space, that there's a lot of ways that they can get into it without, again, having to, like I said, jump into the deep end of the pool and just start swimming with a full revolving credit product.
Yeah, and Scott, I know you talk to a lot of businesses that are kind of in that introductory stage of, hey, I'm interested in credit cards, trying to figure out how to do it. Where do you see kind of like the biggest blind spots they may have? Or what do you wish they asked you when you first started talking to them?
Yeah, one of my favorite questions to always ask people is they're starting to get into it. And we at LoanPro, we work with a lot of lenders. So one of the first questions I like to ask is, well, are you going to be the program manager? And I always kind of chuckle because oftentimes their response is, well, what's a program manager? And then I always say, you need a program manager. So I think a lot of the blind spots that people see, and we talked, I think a little bit, maybe I think it was Alex or Matt mentioned this a little bit earlier. Debit cards are hard enough to be a really good, solid program manager and getting direct deposit coming in on the debit side. It's a lot that much harder to be a credit card program manager. So I think some of the blind spots are just the experience that someone has or doesn't have about where they fit in the ecosystem. If you're a lender, you're very good at lending money, but it doesn't mean that you're great at managing card programs. And conversely, if you're a debit card program manager, you might be really good at being a card program manager, but lending and capital and the compliance and the cost of capital and all of the things associated with that can sometimes be what I would call a blind spot. So a lot of it, I think, Nick, really depends on where someone comes from the ecosystem and where they fit as far as like what blind spot they may or may not have as far as what their current business is today.
Yeah, totally. And so before we kind of dive into the details around product strategy, Alex, I wanted to ask you a question around, there's a lot of new companies launching cards, and I'm curious from the new entrants in the space, where do you see them getting things right and where do you see them getting things wrong?
Sure. Getting things wrong is pretty easy to diagnose, which is, hey, Chase's credit card business looks like a great business. We want to have that business too. You are walking into a world of hurt if you try to sit down and say, we're going to go compete with Chase, with American Express, with Capital One. I can't really emphasize strongly enough how sophisticated those companies are, specifically around their credit card offerings, how they leverage the scale that they have, both in terms of their infrastructure as well as their customer base, to create just unit economics and product structures that are just not achievable for other companies, right? Even very large public fintech companies that have launched credit cards, or very, very well-funded private fintech companies that are getting into credit card, they still don't have the scale and sophistication to play that game. I would say, by contrast, the ones that I see that are doing the best are kind of building on the points that Scott and Matt have made, the ones where they sort of know exactly why they're doing it, who their customers are, and crucially, like how the credit card can act as like a force multiplier for the rest of their business, right? Credit card as a standalone product is tough because you're just going to be competing against the top of wallet cards that everyone already has, your Chases and American Express and Capital Ones. But I think the flip side is if the credit card acts as a force multiplier for your checking account, your savings account, your investment product, the other sort of features and products that you've built into your ecosystem, it can be an enormously powerful accelerant for the other parts of your business, and it can be the most profitable component of that larger ecosystem as well. And so credit cards designed with that mindset and, maybe a little less ambitious, but a little more realistic, those I think tend to work better. And, over time you can grow those and you can expand your reach in credit card. And maybe you can start to peel some customers away from Chase and American Express, but starting to do that on day one is where I see people make mistakes.
I
I
think,
think, go ahead,
you
Matt.
know, sorry, go.
No, go ahead, Matt.
I think what's interesting, I work with a lot of 0 to 1 startups who do want to build a credit card first. And usually the first thing I tell them is it's a bad idea and they shouldn't do it. And people say things to me like, I'm going to use a credit card as a wedge. And I used to say that's insane, although then Built proved us all a bit wrong on that one. I think one of the fun things about working in fintech instead of, traditional fin serve is people trying whole net new things. And to kind of build on what Alex said there, the key thing that you have to look for is what is a meaningful way that I can acquire users that's unique and differentiated. I have a lot of folks come to me and they're like, well, I'm just going to buy ads on Credit Karma. And I'm like, they're not even going to take your call as a startup. They don't have the time or the ad space. But you think about Built's example of going through property managers. Do you have some channel that's unique to you? And that's still hard to make work, but you have to have something there. And you kind of have to go, at an angle, zig and zag versus the traditional issuers. You can't face them head on, as we kind of said in this panel. But I think there is something there where, someone will figure this out, as Built did, or others will, and blow it up. And one of the other great examples, I think, and Robinhood is obviously a big company and public and all those things. They're not a startup, but a lot of money is spent on sign-up bonuses. And instead of doing a sign up bonus, they said, we're going to give you 3% cash back. And everyone's like, well, they're losing a bunch of money. And like, well, that's sort of true. But also, Chase is giving you, $1,000 worth of value on a Chase Sapphire or whatever when you sign up. And it's actually an interesting marketing, moving stuff from bucket A to bucket B. And we'll see how sustainable that is. Like, Robinhood probably won't have 3% cash back forever. You can flag that as my prediction. But I think there are some ways that companies are trialing doing things a little bit out of the box, because the challenge the traditional large issuers have is they're very successful, and so they have no reason to kind of rock the boat or try new things. And one of those new things is going to break out, and really change the market.
Yeah, and Matthew, you touched a lot on what I was thinking as well. Is you look at this, and Alex, that flywheel effect is for real, right? And that force multiplier within the card space, I think, is very, very real. And Matt spends a lot of time with early stage companies that do this, and I think he's spot on. I mean, you can go back 5, 10, 15 years, and the side of the road is just littered with the wrecks of card program managers trying to get that spend a lot of private equity, investor capital money on crazy customer acquisition strategies that just didn't work. So to me, to be, as you look at this, to maybe put a final point on this, is it has got to absolutely be additive to the business. The Robinhood, credit card, I think is a fantastic way of doing this. Standalone credit cards are incredibly hard to do. There are, again, as Matt mentioned, some rare exceptions out there that work. So I'm not saying that there won't be the next one, next week or tomorrow, that it will be the exception. But the rule is standalone is very, very hard to do. But again, if it's additive within the business, and I love Alex's point of force multiplier, those ones get very, very interesting. And that's where we really tend to see those ones be kind of the long-term successful credit card programs.
Yeah, totally agree. And so starting to dive into like product strategy and how companies should be thinking about it. Um, obviously one of the first places to start from is who are you marketing to? Who's your ideal customer? And in lending specifically, there's very wide ranges of credit scores, how much credit somebody can take on. So, Matthew, I'm curious to get your takes on like once a company determines who they'll be targeting with their credit card, what are the biggest areas this then influences or should influence in their product strategy?
Yeah, one of the interesting things about credit cards is they're sort of a chameleon, and the product acquires users for different reasons depending on that credit scale, right? If you're in the lower middle income bracket, your lower credit score, like you're getting a credit card for access to capital, right? It is a lending tool first and foremost, and rewards either don't matter or are nice to have or whatever have you. If you're high credit score and high earning, you're not getting a credit card as an access to capital. Like you may eventually use it that way. I think it always surprises people that about a third of all revolving dollars are on super prime users, but you're not planning for that. That's something that might happen again when you have a job change or something. But you're looking at the rewards. And so the fundamental kind of look of the product changes depending on who you're going after. And as was mentioned, like you can't be all things to all people at the same time. So you have to think about who is your existing user base or who are you going after, and therefore what do you need to lead with? And so if you look at the like credit builder products that are, path to more credit, secured or partially secured, alternative ways to secure a card, we've seen some really interesting stuff, I think, lately around kind of trialing something other than cash. Because one of the great ironies of cash secured cards is like if you had spare cash lying around, maybe you wouldn't need a cash secured card. So there's a little bit of a, challenge there. But then, again, if you're going after the high end, it's like, how do I get rewards and experiences and benefits? And you see this if you go to any major bank, regional bank that has a suite of cards, they have like four cards usually, maybe three. And it's like, the secured card builder, the like low interest one, those are for people who need access to capital. Then they have rewards and they have like an ultra premium rewards, and those are for people who are high earners. And that's, I think, a great way to look at that segmentation. Those banks aren't doing credit cards to own the market. They're doing it just to fill the gap in their product suite. And it shows you kind of how to think about those key segments.
Yeah, and you mentioned rewards, which obviously for a certain portion of consumers, that's the big thing they chase is, where can I maximize rewards? Alex, I'm curious your take on how companies should be thinking about rewards as part of their overall offering, especially because, when you talk about credit cards, rewards inevitably come up.
Yeah, they do. Rewards is a tough one because, again, I'm just going to keep hitting this theme over and over again. If you think you're going to like outspend Chase or American Express or Capital One, think again. If you don't have a budget to like fund the construction of new lounges at airports across the country, like you're not playing the same game that the big guys are playing. So wandering into that and being like, yeah, I think we can do 3% on this, 4% on this, we'll be more generous on these categories. Like all of those determinations, and Matt can speak to this in much more detail than I can. All of those are based on like rigorous understandings of unit economics and how you can make the math work at different scales. And if you screw that up even a tiny bit, you can get wiped out very quickly. So rewards in that context are very dangerous. I think that Matt mentioned Built before. We should just pause for a second and say that Built is like a unicorn that doesn't really apply to the rest of the world. Like they had a business model and a reward structure that depended on their counterparty, Wells Fargo, signing a shockingly dumb deal. It's really hard to convince counterparties to do that. And as we're seeing with the rollout to Built 2.0, that arbitrage opportunity, even if you get it, doesn't last very long. And now Built has kind of encountered some rough waters as they're making that transition. I think a much better way to think about rewards is to remember that for all of the sort of obsessive point optimizer folks that are out there, and Matthew, I'm looking at you, there are many, many, many more people who just want like a reward structure that more kind of matches how they want to live their life. And that could be from a time saving simplicity perspective. So sometimes you see issuers roll out products that have like a like purposefully simplified reward structure that just makes it easy. You don't have to think about this. Sometimes the rewards are tailored to certain types of activities or certain communities that their target segment participates in more. And sometimes it's much more of just an affinity play, right? There's a reason why community banks and regional banks usually still offer a card that is offered in partnership with the alumni association at the local university, right? Because I want the logo of the team that I rooted for in college and I still root for to be on the credit card or debit card that I offer. So there's a lot of ways to win in rewards and marketing that don't require you to go head to head just in terms of the raw number of points.
One of the things that
Alex, do
we've
you
built, and
have a
I,
Montana State card?
Yeah,
yeah, do
go
you have one,
Bobcat.
Alex?
Montana State. I do not. I preach this and then I don't actually have it. I'm a Capital One
Is
customer.
there a Montana State card?
I think there is. I think one of our local banks offers at least a debit card for it, and I really should because we won the national championship last year, and I'm still riding a high.
Right.
So I should do that.
I love it. Yeah, and one of the things on rewards, I think, and Alex and Matt know the reward space inside and out. One of the things, I don't want to turn this into too much of an infomercial, but one of the things that at LoanPro it's so interesting is the way that we think about this is there's always cards. We know interest rates and rewards are the two levers that people can pull, but we've built a component that we call transactional level credit that allows card program managers who are running their card programs on LoanPro's ledger to have a custom interest rate, a custom interest abatement period, a custom credit limit to the MCC, or even down to a per transaction level. We can geofence transactions. So going back to Alex's great example, he could be at a Montana State football game, and if he was running, a card that was running on our platform, any transaction done within, 2 miles of the stadium at a restaurant or bar on game day could have a specific credit limit, interest rate, or interest abatement period. So there's things that you can do within this space that aren't just trying to go head to head and punching, uphill against Chase and Capital One and their rewards, and you just won't win that, for everything that Alex and Matt know inside and out on that side. But there are some ways that you can think about building highly targeted credit card programs with kind of laser focused types of offers that you can run, that you can get very, very competitive with some of those just broad-based rewards programs in the marketplace.
I mean, I think that the big way to win in rewards, as I said, you can't go head to head cash back. You can't build airport lounges. You have to find something that you can create. What's great about rewards is it creates this differentiation between the physical cost to the card program manager and the realized value to the end user. And the reason it's so big in airlines, right, is they have this funny thing where they have kind of like zero marginal cost a lot of the time for that last seat on the plane. So I can value an American Airlines mile at 1.7 cents, and American Airlines can value it at 0.8 cents, and we can both win, right? Like, this is not normal in the world, but it is possible, and you can find ways to do this. You can work with wholesalers or get access to things. Like, when I was doing my wine credit card, we bought really fancy wine glasses at wholesale price that, like, we could deliver them at really high value to our users and not have to pay all of that because we were guaranteeing us an amount of purchase volume. And similarly, the thing about points, if you go after that, is it gives users a psychological freedom to just spend the points. I actually think it's really dangerous to include cash back as part of your points options, because if I have pure cash back, like, it pays my bill, right? It auto deposits onto the statement or my checking account. I'm like paying my power bill or my groceries, and like, that's nice. And for a big segment of users, that's what they want. And there are lots of products for that. But if I can only use them as points, it's like, oh, woe is me. I have to take a first class flight to Tahiti. I mean, people don't really do that, right? Like, that's just the promise. But it's this psychological permission to kind of enjoy things and get that little bit back. And I think where fintech programs in the consumer space who do want to compete, they need to find something that's unique to them. And so we'll pick on the Montana State example that's here. Like, if Montana State went beyond a logo on a card product, and identity is huge, as Scott mentioned, like, people love identity on cards. It's part of our modern consumerist tribalism. But Montana State said, hey, if you have our card, you get access to a pregame warm up, or you get, earlier access to buy season tickets, or you get discounts at the snack bar. Whatever those things are, that's real value that may not actually cost the program manager Montana State very much money, and makes that card a kind of a no-brainer win-win for everybody. And that's where having that underlying asset whatever it is, a stadium, a program, some physical goods you bought at wholesale, whatever they are, that enables the whole ecosystem to work.
Yeah, I mean, just building on Matt's point for just one second, because I think he touched on a really, really important idea. There are so many intangible things that consumers value that you might have discounted or free control over to your point. And like the stadium example is a great one. Like if I could get early access to the game to go walk around the field and like throw a football around 2 hours before the game started, like there's no cost to that really. But the like psychic value that I would get out of that as a card holder would be massive. Costco's another example, right? Costco's like premium membership now includes the ability to get in early. Like it's like an hour early or a half hour early before everyone else can get in, early admittance. My wife despises crowds. She won't go to Costco on a Saturday if it's crowded, but if she can get in before the crowds, that's a huge value. And to Costco, it's nothing really, right? It's just open up a half hour early. It's like a staffing cost that you can easily spread that out across. And those types of levers that you have can sometimes be the most valuable perks beyond cashback or points.
Yeah, and I think like the idea of businesses leveraging either what they're already good at or kind of the connections they have to then turn that into a rewards ecosystem, it goes so far beyond just cashback or, lounges at airports. Like it opens up a whole world of possibilities. And one thing, a lot of the conversation around rewards and credit card strategy started having me think about personalization, where, Alex, your wife values going to Costco with nobody there. That's a very personalized reward that she could get access to.
Mhm.
I'm curious, Matthew, how you think about, beyond rewards, how should companies be thinking about personalizing their credit card program? Like, what are the different levers they can pull to actually build a product that's uniquely fit for their customer base?
Yeah, I think there's a lot of experience things as well. When you think about cards that allow you to even select your due date, have flexible ways repay your monthly bill. You see a lot of basic programs like, well, auto pay only works this one way. It used to be that, you had to call in and say, hey, I want to change my due date. Maybe that makes a big difference for your cash flow, as well as the idea of kind of pick a tier or pick a benefit. I really like these cards that are like, maybe a great example is Bank of America's customized cash rewards card that they've had for a few years, where they say, hey, you get 3% from whatever category you pick amongst this list, right? And they made this kind of universalistic card for people who see what matters. You can pick online shopping, you can pick gas, you can pick groceries, you can pick what matters to you. And I think it's a great way of allowing consumers to personalize, because in our modern era, right, we're all used to the niche product for ourselves, right? We can go on Netflix and get the exact right movie. We can go on social media and get the exact right video. And so I think it's a big challenge for banks that have traditionally said, like, how do I have the fewest products with the most users per product, right? Just from a scale perspective, to figure out how to kind of algorithmically personalize. And that's, where I think like Scott's point on LoanPro's capability to, customize APRs and things is really interesting. What if you said to someone, hey, you can pick one category where you get an extra grace period? There's been a lot of small business cards historically. There's this Amex Plum that I always love as an example, which is still out there and very under the radar, where business owners can pick to pay their card in full in 10 days and get 1.5% cash back, or pay their card in full in 60 days and pay no interest and receive no cash back. And if you run a small business, sometimes cash flow is hard. And so Amex is saying, like, this is a very clear trade-off, and you can make it on a month by month basis. I think that's an area where especially fintech can really innovate with modern ledgers and more modern systems. I assume it cost Amex a fortune to build that capability in their core, but we can probably do it much faster with our modern tools and create these neat options, right? What if you're an e-commerce seller, right? How do you align your credit card so that it's always due after your Stripe or Shopify payments come in, right? So I think there's a lot of interesting ways to personalize.
Matt, you touched on something that's really interesting. I was in Canada last month talking to one of our prospects, and they pulled up every credit union. They pulled up, I think, 8 or 9 different credit union websites and showed the exact same credit card offering with just a new logo for all 9 or 10 of these. And to Matt's point, we now have, with these fintech stacks, we have the ability to do some of these things to be very specific down to an individual cardholder level with these types of features, functions, changing due dates, all of the things that you can imagine, custom statements, et cetera, that really allow now the bank or the program manager to go in and personalize. Because so many of our, archaic credit card programs, again, just don't have the right technology stack to be very flexible in the things that a consumer wants when they want a very personalized card program. So I think that that's one of the kind of the key things that again is as we look at ways to help our partners in the ecosystem, more broadly offer personalized programs. It's to really allow and give the personalized experience on those types of use cases on a product by product basis.
And Alex, kind of talking personalization, I'm curious your thoughts on personalizing for the younger generation. Think younger millennials, Gen Z. Obviously, this is emerging as a group that uses credit cards a lot, and it also is a perfect kind of target market for people to capture these people that maybe don't have a credit card yet. This is their first time accessing it. So, any thoughts for companies that are looking to target the younger generation on how to structure that credit card program?
Yeah, for sure. I mean, the first thing to say is that all 18 to 24-year-olds in the history of mankind hate credit cards and see no value in them. And almost all 28 to 35-year-olds love credit cards and see a ton of value out of them. So never believe the headline that's like, generation whatever is killing credit cards or has moved on from credit cards or has chosen debit over credit cards. Those headlines are always written. They were written for millennials. They were written for Gen Z. They're now I'm sure being written for Gen Alpha as they grow into that stage. And none of them are true, at your point. As Gen Z has sort of gotten slightly older, they've really started to embrace credit cards at numbers that are actually greater than previous generations, right? So we see the adoption by younger generations of credit cards as an accelerating trend, not one that's going the other way. To personalize for younger consumers, again, I think it's important to be very specific in terms of who you're talking about for younger consumers, right? There's lots of different types of younger consumers. And I think if you use like fintech history as a guide, a young customer that SoFi went after originally was a graduate student from a top tier university. That's very different than a young consumer that Chime went after, right? And so SoFi very quickly got into offering rewards-based credit cards. I think they do a really good job of tying it into their broader ecosystem. So the young customers that we're getting are coming to us to pay down their student loan debt. They're very focused on sort of getting their money right, and they want to have the credit card be something that accelerates that. And so SoFi designed a very good rewards credit card that helps sort of be a force multiplier for their whole sort of get out of debt, build a good financial future ecosystem. Chime, by contrast, still going after young consumers, but they were going after young consumers that were approaching it more from the perspective of, I don't know how credit works. I don't know how to build credit scores. I don't know how any of these systems function. Can you give me a credit card that helps me build my credit score? And going back to Matt's earlier point, that doesn't require a massive cash deposit that we put up. And quite frankly, from a marketing perspective, doesn't make me feel like a loser because I don't understand how the credit system works. And that's a problem with a lot of the secured cards that banks offer. It's not that the product itself is necessarily terrible. I think Chime and others improved upon it. It's that it was marketed as if you're pathetic if you have to take this product. And Chime said, no, everyone has this problem. The credit system in the US doesn't really make any sense. Here's a product designed for you. So I think you have to be more specific when you're talking about going after young consumers than to treating them as like one block, if that makes sense.
And this is a really interesting point on what does your card say about you? So you've seen this just explosion in metal cards, which have been with us for 30 plus years, but now like everyone's got them, including Chime, and people are willing to pay for them. And in the US, this is not true elsewhere, right? There are other countries where still like kind of having cash is king or showing you use debt is kind of a social faux pas. But in the US, having access to credit shows that you're like worthy. It's a unique American thing as far as I know. But like we used to when I worked at Green Dot 20 years ago, we were making, the reloadable prepaid debit cards, the like beginnings of the beginning. And, for people who couldn't even get a bank account because they'd bounced too many checks, we had this card design concept, which was the date test. Can you take this card out on a date and not feel embarrassed by it? Right. And that was a really important guiding principle for us. Like we designed the first Walmart prepaid card and they wanted to put a giant smiley face on it. We were like, please don't. Can we do something classier? Right. And it didn't make the card more expensive, but we did sell an upgrade black card, which was very, very popular even back then. And this is about that identity. And I think that's where we see fintechs realizing this much more than traditional banks have, saying, that extra little investment in making our consumer feel better about where they are and where they're going can make a really big difference. It's no longer just metal cards for platinum card holders at Amex. Like I think Chime lets you pick from amongst three. The other global neobanks like Revolut and Monzo are famous for their card design and the effort they put into them. And I think this stuff really matters because a card, again, it's your primary financial tool. It says much more about you, or people perceive it says something about them, than it's only a product that they use for finances, because it is in your wallet. You take it out, you use it. It's not like an ACH that you never see, right? And I think that's just a big part of thinking about the marketing and how to connect, because as Alex said, I think this story is repeated with generations. There are more and better products today, but people still want to say I'm smart with my money. I'm savvy. I use Chime because I choose to. I use this, card because I earn rewards towards the thing I care about. And that's really a huge motivator for acquiring a product.
Matt, I love your date example. Could you imagine, Alex gets back to the early discussions on credit by generation. Could you imagine going out on the date and be like, hey, can I do an Affirm or Klarna buy now, pay later, pay in four, while you're getting the check on your date? It really is. It does really say, yeah, I love the date example, but that's really what you're trying to say when you're pulling out that card out of the wallet. But yeah, that's why I always joke. It's like, there are wonderful use cases for buy now, pay later, but there's obviously ones that are not.
And so we only have 10 minutes left. Kind of, I want to get to a few audience questions, but first I want to touch on infrastructure. Scott, you mentioned previously, the infrastructure out there for building credit cards is better than it's ever been, and it enables more unique functionality than it ever has. Now, obviously, you and I we're biased with LoanPro, and then also the Synctera credit card infrastructure, which we're partnered with LoanPro, so we have a lot of those similar capabilities. So, someone less biased like Matthew, I know you work with a lot of different providers and you've looked into them. I'm curious, like, what are the main structural decisions that a team should make when thinking about what infrastructure provider to use?
Yeah, no, great question. So I think a couple of things that are really interesting, and we've touched on a few of them. I think fundamentally, a couple of things to keep in mind as you're looking at your infrastructure and your partners. Credit is fundamentally harder than debit, right? So I think kind of keep that top of mind as people are looking at infrastructure and partners and finding the right partners. Because a credit card is not a debit card masquerading as a credit card. It is a very, very different vehicle. So I think you have to start on that side. I think you also have to really look very closely at, kind of all the parts of the ecosystem as we know. Some banks really want to drive deposit growth and be BIN sponsors on debit and don't want to get anywhere near doing credit. So I think that that's another one, kind of really looking at the bank partners and what they bring to the table as well. And I think as you keep kind of peeling back the layers of the onion, you look at this and you say, yes, I would, again, strongly recommend using modern technology stacks. I won't be too biased, but yes, we have a wonderful partnership with Synctera. LoanPro is a very, very highly differentiated modern credit card ledger. Those are the types of things that allow you to really win, like we've talked about, as someone's looking to get into this. Because like we've said, and we'll say it over and over again, you're not going to punch uphill and beat Chase or Capital One on their rewards program like we've talked about. So let's talk about other ways that you can get really specific. And so much of that, I think, can be driven from the right technology stack, the right ledgering that allows you to offer these highly differentiated, personalized custom products using that technology stack.
And Matthew, I'm curious, like, are there core things about how a business is thinking about their product that influence what that infrastructure decision is? Like, regardless of which provider you go with, are there kind of key tenets of if you want to do this, you need to look for this? When you talk to companies, how do you approach that?
Yeah, I think that one thing that was mentioned earlier on in this panel was the program management question. And so I like to start with people like, do you want to be your own program manager? The answer usually it should be no, frankly, right? Like I think if you have an existing program and you want to essentially buy margin for your company, you can bring more and more services in-house. But for most companies where the credit card is probably not your only or your core product, or you're maybe not even sure how big it's going to be, working with a program manager is the smartest solution, and a platform, again, like Synctera or others that do a lot of things for you. There is so much to do. There's underwriting, there's servicing, there's collections, and not all providers offer all the things, right? Like maybe you have to do your own tier one support. Maybe the provider offers it. That's a really interesting strategic question for a company. Some companies are like, I don't want to touch tier one, and others are like, we're really good at that, and we don't want anyone else talking to our user. So there's all these kind of strategic discussions about the big list of roles and responsibilities in a credit card. You need to decide which ones you want and try to find the provider that matches up best against that and really limits the number of net new things you have to build. You already have this huge mountain to climb to launch a credit card. And so what I tell people is like, look for the smallest mountain, right? Who's going to get you up to base camp and give you that huge advantage so that you can focus on what's truly unique about your program. And if you're hugely successful and 3 years down the road, you're like, I want to bring something in house, then you can have that conversation with your provider or look at moving or whatever have you. But I think a lot of people overbuild on day one. And you look at companies again, like Robinhood spent what, $80 million buying a credit card program in order to stand up their program. Like it's a huge lift. So I really think that, I mean, even building on a program manager is a big lift. So I think that's really where I tell people to focus on is like, what's their strategic value? And do you want to be a credit card expert company, or do you want to have a credit card as part of your product portfolio?
Yeah, totally. So I want to get to some questions. Thank you all for that conversation. I think obviously we could go hours more and still be able to dive into so many different facets of the credit card market. One that I saw come in that I really want to get your thoughts on, Alex, given you have some snarky takes now and again, is buy now, pay later.
Yeah.
How do you see this kind of fitting into the ecosystem? Is it something that credit card issuers should be worried about, or kind of what are your thoughts on that whole space?
Sure, yeah. So buy now, pay later, obviously, it's growing very quickly. It's growing off of a small base, which I think is important to note. And so when you compare like overall spend volume on buy now, pay later versus credit cards, it's still a drop in the bucket, but it is growing quickly. The way I think about buy now, pay later is that it's really designed to try to eat into sort of unintentional or undesirable spend that gets revolved as a balance on credit cards, right? One thing we know about credit cards is they're a pretty poor way to borrow strategically, right? Because it's an expensive interest rate, it's a variable interest rate, it's unlikely that the interest rate is going to get capped at 10%. And so BNPL has had a lot of success at saying, hey, instead of revolving that big purchase, you should just finance it. And we'll either do it at 0% interest or we'll do it at a fixed interest rate or fee that's more reasonable. And what's been interesting is that specific point of competition, which I think is a very valid point of competition in the market, has actually forced credit card issuers to respond. And so now what you see is buy now, pay later as a feature being built post-purchase into credit cards so that if someone is using their credit card and they put a big purchase on it and they say, you know what, I don't really want to have that on my credit card balance, they can then convert that into an installment fee for a fixed installment plan for a fixed fee. Those features, according to research from the CFPB, have become extraordinarily popular among cardholders. And so I think it's a good reminder that when you see this like new thing that comes in and says credit cards are evil, this thing is better, you shouldn't take that 100% on faith and just believe that that's true and credit cards are going to die. But you also shouldn't dismiss it as just, oh, that's for people who don't know what the hell they're doing, because usually those products have a point, and a lot of times that's a point you can borrow and build upon.
And to Alex's point, we have seen an explosion over the last, 12, 24 months of post-purchase installments. And this really talks about the blurring of these worlds between a physical card transaction and an installment. But we see a lot of post settlement or post transaction where again, oh my gosh, I used my credit line and I went and bought a couple of flat screens at Best Buy for March Madness, and oh wait, maybe I actually now do want to roll those over to a pay in 4 or pay in 6 type installment. So you absolutely totally agree with Alex's point there that we are seeing a big kind of explosion in those types of transactions that really blur the lines between like true installment lending and card as access devices to those types of transactions.
One other question I want to get to, I'm taking the question in a slightly different direction. It's asking about how Chase can make the Apple Card succeed where Goldman Sachs couldn't. But I'm more curious from like a macro view where these banks are partnering with whether it's Apple or a fintech brand or Robinhood. Like, what should the bank be thinking about to make sure that this program succeeds? Scott, I don't know if you have any perspective on kind of the bank side of things.
Yeah, I would go back to some of the things that we've touched on. I mean, to me, for this to truly be successful, it's got to go back to that force multiplier or the flywheel effect, right? I think Chase has got to be playing this and saying, I'm going to be able to make this successful because I'm hopefully going to sign them up for a checking account and other products, et cetera. So I think that's one of the areas where they're really going to succeed. I think that, as we know, I mean, they know that business as well as anyone. I always personally thought that was a tough putt, to use a golfing analogy, for Goldman Sachs. I just don't think that this is in their wheelhouse to really think about being a consumer focused, retail, bank. So I always thought there was a little bit of a square peg into a round hole with who they chose for this. But if somebody could make it work, it probably is Chase, because they know the credit card space, as we know the big 3 or 4, they know that inside and out. So I think that they're definitely looking at this as saying, yeah, can they turn this into the flywheel effect and really make a run at this thing?
Awesome. Well, I know we're just about out of time. Just want to thank everyone for attending. If you have any follow-up questions, my email is pretty simple, nick@synctera.com. Feel free to reach out to me. I want to thank Matthew, Alex, and Scott. Super interesting conversation. Thanks for doing this, and thanks for being voices out there about the credit industry. I know, we have some fintech voices out there, but I love the angle that you typically take around credit specific because it's such a beast and so many different facets to think about. So thanks everyone again. Thank you for taking the time to join us, and we'll see you soon. See you, everyone.
Thanks,
Thank you.
everyone.
Thank you.